Well, good afternoon, ladies and gentlemen. It's a pleasure to be here. I have a very big and distinguished panel, so we won't keep you very long, but we have a very interesting topic to discuss. Please let me begin by giving you a textbook definition, Dr. Stopford. Shipping is a capital-intensive industry. We all know that in this room. And I would like to add that shipping is a human capital-intensive industry in today's market. Shipping finance used to be relationship-based. Today, it is totally different. Of course, the borrower and the banker, the financier, the lender, know each other, but the meaning of relationship, the way a lot of us in this room have known it and experienced it, has totally changed, and I will dare to say, has gone forever. What has also been archived in the shipping finance history books is the agreeing of the terms of a loan on a handshake, ladies and gentlemen, and then having one lawyer come in and draft not more than a 10-page document for the closing. That has gone away. Today, we are in a totally different world. Regulation has come into our life, and it is often said that shipping and shipping finance is now totally overregulated. Make no mistake, change is here to stay, and we need to adapt and be flexible if we are going to move forward. Now, within this rapidly changing environment, shipping finance must again become attractive to banks, but to borrowers as well. And is this possible? This is what we're going to discuss today with my distinguished panel, and I may dare to say, debate among us, as we are expecting to do. Let me first of all introduce you to my distinguished panel. Mr. Andreas Chrysostomou, Chief Executive Officer of Marine Fields, Mr. Christopher Conway, Managing Director and Global Head of Shipping and Offshore Export and Agency Finance of CitiGroup, Mrs. Alexandra, Michalopoulos, Partner at Watson, Farley & Williams, Mr. Marc, Executive Director of Shipping Finance and ECA Macquarie Bank, Mr. Christos Tsakonas, Global Head of Shipping, DNB Bank, Mr. Stavros Gyftakis, Chief Financial Officer, Seanergy Maritime, and Mrs. Korinna Tapaktsoglou, Chief Financial Officer of Pioneer Marine. I would like to start off, ladies and gentlemen, by hearing your views on the following question. What is the real risk in shipping? The asset or the person running the asset? Korinna. Very briefly. No? I can stand next to you. I'm being heard quite loud.
Okay. Katerina, thank you, first of all, for inviting me in participating in that panel. It's a tricky question. Of course, having a good asset, a new vessel, environmental friendly with low consumption might help, but at the end is people and management those that decide which assets to invest in, when to enter in the market, when to exit in the market, how to overcome all the difficulties, how to comply all the regulations. It's mainly the human factor and the management that is that will lead a company to profitability or not. So I would say, the main risk is people, not asset.
Okay, thank you. Stavros?
Good afternoon to everybody. Thank you, Katerina. So actually, I would take a similar approach as Korinna. I would say that analyzing both risks is equally important, but the human factor, so the operator, is maybe a bit more substantial as a risk to be analyzed by any lender and by any company. So if you have a company who knows how to operate efficiently, how to maintain efficiently, and has the commercial reach to charter profitably its vessels, then you're basically addressing both risks at once. In DVB, we used to say, stay away from SOS assets, which means small, old, specialized.
Okay.
But experience has shown that even these type of assets, if you put them in the right hands, they can pay back their debt and they can be profitable.
So you also put it on running
On the operator, the owner.
Okay, I'm conducting a poll here to start off the question, and you obviously can understand that banks are looking into the risk, first of all, so.
No, it's definitely the people that pay you back. Of course, these people make choices. They are the ones who choose the assets to invest in. We've had a very expensive education the last 10 years with pretty much every sector in shipping in crisis. So we have seen who has made the right choices and who hasn't. So as a lender now, it's a little bit easier to choose who to back. But I will agree with two people before that absolutely it's the people we bet on. It's the choices they make that create their reputation. And it's very much the people that we expect to get paid back from.
Excellent. 3 out of 3.
Good afternoon. So my view
Marc.
is that both matters, the asset and the owner, the people running the asset, consistent with Macquarie's approach in equipment finance around the world. We take an asset finance approach, and that's why we are comfortable providing limited recourse loans. We will finance projects, and that's also why we have a seasoned superintendent as part of our shipping team. So we care deeply about the assets we finance and the yard it was built at. But I of course share the views of the other three that the owners matter, and we care deeply about the owners. It's most often human errors which drive incidents, and it's the risk mindset of the ship owner and the crew they select which drives a zero incident environment. We wouldn't lend to people violating sanctions, of course, or owners with a very poor port state control record. So both matters, and by the way, we don't think size matters. Size doesn't necessarily influence quality, and that's why we'd be happy lending money to large and medium-sized small ship owners.
So you're actually answering both.
Since we are colleagues but also competitors, I would like to quiz you a little bit. You know, in shipping, being so cyclical, you have assets that are fluctuating in value from 150 million down to 60 for similar age assets over the cycle. I mean, how do you select when to actually get in? Do you actually take a bet on which part of the cycle you're on? Have you been successful in doing that? Or do you let the management teams do that for you? How do you really, time the cycle in that respect?
Yes, so we certainly look at the market environment and try and take a counter-cyclical approach. We'll put the brakes on if markets get too frothy. That's basically the approach.
Okay. Thank you. Alexandra?
Good afternoon. I would tend to agree with the panel. I mean, we're sitting on the legal services side, so we're advising both owners and lenders. And I would say that the management and the operation is extremely important. We see that in lenders' credit decisions, and we also see it on the ownership side, where owners are trying to keep up with compliance and all the other factors that are important in running the vessel. So
Okay.
I would agree with the others.
On the human side. Chris?
Thank you. Look, there's no doubt that the risks are everywhere in this industry, and we have, like my colleagues in the banking sector, always chosen to have as our customers people that we believe will do the right thing through the downturn. And at Citibank, we haven't really expanded our target market very much. We add clients on a very, very selective basis purely for that reason. And throughout my career, I've had situations where we add customers to the target market, but because of the vagaries in the industry, in a downturn, what looked like a good decision in day one looks like a stupid decision in month 9. But then if you fast forward a few years, and when that company's behaved as you hoped they would when you brought them in, you're vindicated. But the issue, I think, that we as bankers face through regulation is, as you described originally, that there's no name lending anymore. We have very stringent bank regulation that impacts the way we deal with credits as they go through their life cycle. And we have other colleagues in the bank who maybe don't have the same relationship that we have. And so it becomes a big challenge to make sure that the entire organization is pulling in the same direction for both the industry and their client.
Sure.
What worries me is we know that there is change coming, but do we know what it is? And do our clients really know what it is? Have our clients read the tea leaves correctly? How fast is it coming? And who are making the rules? I mean, what's clear to me at any rate is, as has been described by some of the other panelists, you've got communities out there who look at shipping like it's got a big target on its back. We are the bad boy of the community that creates pollution. And banks rely on other people to invest alongside us when we're financing very large-scale capital assets. Some of these institutions who are large-scale investors with huge amounts of disposable income aren't necessarily going to want to invest in this industry. And it's quite interesting to see how there's now something like $30 trillion worth of money that have gone into ESG funds. And really what I found surprising was a comment of 2 days ago that Tesla is now the highest valued auto company. Who would have thought it? And how did that happen for a company that doesn't make any money? Well, it's quite simple in my view, that what's happening is that those who have large amounts to invest are doing so in those funds that qualify as green or ESG compliant. And Tesla, if you're thinking about investing in the auto sector, if you've got to diversify your investments and have to invest in the auto sector, Tesla's going to tick all the boxes.
True.
So there's a lot we don't know.
Other than the profitability box, but every other box is
Correct.
Yep.
Get that from SpaceX.
Andreas?
My answer to your question would be directly saying, don't we always blame the reckless driver?
Yes.
I mean, if you look on any kind of accident, you're going to say, oh my God, what a reckless driver. You're not going to say a reckless car. Now, your question for me, coming from mainly the engineering background, it's a little bit limited because it finishes to who operates the asset.
Yes.
But we have to have the responsibility for risk by those that design the assets, by those that they actually put the hidden assets on the assets that the operator doesn't know. So in a chain of risk, in a chain of events to come to the risk, there's a much more, what you call it, line of people that we're playing. But the assets itself cannot be a risk. I never seen a car causing a risk by being parked, unless it's been parked on the wrong place because the driver made a mistake on the place he parked the car. So in conclusion, it is a human error, and that human error will cause the risk. So that I will leave it to that, and then we can discuss further what you have.
I think we will. I was planning on asking another question, but I will air it and go on, and I would like you to include it in your other answers. And that is, you all agree that it's actually human error that it puts the greater risk on an asset, okay, on running shipping. So does the current over-regulated environment address these risks from the banking side and from the owner side to prove how confident or capable they are? Keep that and address it with my next topic, which I would like to lead my panelists, and that is regulation and bank financing policies. Now, I would like to begin this, if you allow me, with the lawyer on the panel. And Alexandra, can you please, from your experience, and very shortly, give us or tell us your experience with the new regulations that are now being imposed on the banks and on the owners, like Poseidon principles, hazardous material certificates, green scrapping, green passport, green financing, green everything. What have you seen and what is your experience as a lawyer?
Thank you.
How is that coming?
Yeah, it's a
being
really
accepted?
broad question, but I want to start where you started at the beginning with the 10-page document, handshake, and the relationship, and we all agree that's gone. Documentation has become more intensive to cover all of these risks. The regulation, other panelists earlier touched upon, including sanctions, including for us on the governance side, anti-corruption, KYC. These are all things that have come up recently and were not part of that agreement that you referred to in the past. Also corporate structures and having ownership companies with the corporate structure and not just one bearer share to an unknown holder with the SPC. These are all gone. So the impetus is on the banks to control all of these factors, and they did take it into account in making their credit risk assessments. More recently, because we spoke earlier amongst us about the Poseidon principles, which is obviously foremost on people's minds at the moment, and it is new. The main lenders have bought into that, but also we see it implemented in loans recently where the lender may not even be a party yet, but they aspire to be. And that's partly driven by the focus on shipping and consumers focused on how dirty shipping is and having all of this negative publicity. So the banks are signing up to these. And just indicatively for us, since the Poseidon principles have come into place, we have documented over 4.5 billion in loans, which include the Poseidon principles.
Okay.
So it is important, we do see it. And all the other points that you mentioned about the certificates, green scrapping, that all goes into the loan documentation,
And into the covenants.
Absolutely. But we, as I said, because our practice also covers ship owners on other sides, ship owners need advice on this and they are taking it seriously. So I would say that everyone is aligned in wanting to do the best they can do, but of course the bottom line is cost. And that is assessing that cost and what that...
So you're seeing we're adapting and evolving, so that's going to help us in the future. Okay. I want to add and throw in something that is, again, relatively new and it's growing on the regulation that is coming layer after layer. And that is the EU Sustainable Finance Regulation that is coming into effect soon, and it's known as the Green Deal. Now, sustainable finance in an EU regulation that is an EU, that incorporates ESG factors, where ESG stands for environmental, social, and governance, when making investment decisions. The EU targets this to lead into increased investments in longer-term and sustainable activities. This regulation will apply to EU banks and funds over time. And it's not just going to be shipping, it's for their full loan portfolio. So I would like to ask Korinna, how do you believe all this environmental regulation issues are affecting or will be impacting shipping? As you are a shipping company which has corporate governance, you're listed with a middle-sized towards large fleet. So how do you see that affecting you, impacting you, and believe it will impact others in shipping as well?
Thank you for asking me. So on the owner side, when we're dealing with banks and trying to find new lending, banks and financial institutions continuously increase their requirements, and this is the result of these regulations that concerns environment, IMO, ballast water treatment. In many cases, banks require the owners and the potential clients to comply with those regulations, even those are not yet in effect. So there is a quite big pressure on the companies to demonstrate an action plan, how they deal with that, how they comply with all these environmental regulations, spend money for that, and even before, as I mentioned, becoming effective. Now, regarding this EU sustainable finance, that regulation that brings to the table new metrics, the ESG metrics, as you mentioned, that concerns environment, social, and governance. So even if a company complies with all these regulations, it has to have a very good corporate structure, very high standards of corporate governance, has to disclose social sensitivity, to maintain crew welfare, employee welfare, have high ethical standards, and even more. So let's say that you comply with all that, like Pioneer, like all other listed companies, because we have. There are more to come, because even if you comply with all that, companies sometimes, due to internal policies, they require more. For example, several traditional banks do not provide lending to companies if the major shareholder is a fund. Okay, so even if you comply with all those regulations, we have invested in and have additional costs, you still have barriers. Also, new companies have to prove a track record of 5-10 years in shipping industry. So even there is an entrepreneurship that have proven abilities in other sectors and wants to enter shipping industry, it's not easy to attract lending from traditional banks. And just to conclude, as you understand, all these increases the cost for the companies, and small players that they don't have the resources, they need to spend too much money, and given that volatile market, as previously mentioned by all previous panels, and as my friend Kostas Kondes mentioned in the previous panel, will lead a lot of players, small players, integration or going out of the market. So yes, it's difficult, and it places a lot of pressure to the ship owners, especially when the market is so much volatile.
Yes, let me make a comment. So what you're actually saying is like the Greek saying that the wife of the emperor must not only be honest, but show that she is as well, right?
Yes.
Right.
Exactly.
So that puts, even if you are, and I think shipping industry has always been doing the right thing, transparency and governance has to now be proven.
And to prove with metrics, and to pay more consultants
Which is
to come
cost.
there and prove and give you a certificate that you comply with all that, so that you have better rating, and better ESG rating will provide you a lower cost for financing, and you attract the interest of the investor. So if a company under this regulation doesn't have a good ESG rating, might never get this finance.
Okay, I have a banker who wants to reply to that.
Yeah, I mean, we touched upon a lot of topics, but I think we have to start categorizing it a little bit. You said before that shipping has acted responsibly. Shipping has not acted responsibly when it comes to the environment. Quite the contrary. If you look at the way that ships have been scrapped for many years, if you look at emissions, it has not been done in a responsible way. Now, it's not the bank's job to regulate this, and we are not going to be the policemen, despite the Poseidon principles and all these initiatives we are doing. It's not our job to decide who gets capital and who does not. The problem we have is, if we look at, I work for DNB, and if we look at what our shareholders are asking for, what our employees are asking for, they want us to do business in a responsible, environmentally responsible manner. And we don't have to do shipping. If shipping is not environmentally responsible, we're just not going to do it. So in scrapping, things have to be done in a much better way. When it comes to emission, they need to be monitored in a much better way. The banks are doing some initiatives trying to figure out, okay, which clients do we select? We're not the ones that are going to police, but we are going to be the ones that select who we give money to. That's when it comes to the ESG. When it comes to regulation, which is a separate topic, if you look at Basel III, which now is termed Basel IV, industries which are cyclical and industries which are capital intensive, like shipping, are very, very heavily penalized. And it's not profitable for banks to do plain lending business the way we used to do 5-10 years ago. And banks have changed strategies. I mean, we have focused very much on building up our advisory capability. So we do a lot of bonds, we do lots of equity transactions, but bilateral loans, it's not a profitable business for Western banks. We used to have, 10 years ago, $80 billion provided by Western banks in the syndicated and club market. Today, that's 40. It's half, 10 years later. And of course, the gap has been filled by Chinese leasing institutions who are not bound by the same regulations, and also tend, for the time being, to have a much more lax attitude towards the environment as well?
Well, of course, we are definitely in times that the playing field is not equal or level in the financing sphere.
Can
Yes.
can
Yeah.
get
Can
into
you jump
that?
in here? Yeah.
Just simply because I'm not going to go to the financing regulation right now. I would say something, but in the previous panel, we heard that the civil society is putting pressure on the regulator and sometimes on the legislator, and we get a regulation for shipping or legislation for shipping which is incompatible or non-implementable. And these people are coming with externalities. We hear now we do ship recycling in non-sustainable way. The reason it was stopping coal scrapping is because India was insisting that pitching, which everybody considers non-sustainable, is sustainable because they're using everything for recycling, and it contributes to their social pillar. And that was 10, 15 years ago. But anyway, going back to the regulation of the EU, from my point of view, the regulation is structured very well, and it has in it, and as I said before, when we had a private discussion, the just transition mechanism, which supposedly is there to help everybody like a startup or a company that doesn't have the 10 years to modify itself and get some financing from the institutions to get in line and get ready to get the financial support from the financial institution which has to comply. The problem is if you look on the infographic, it doesn't contain anything about transport in general, not in specific about shipping, which means it will be left to the hands of the Commission when we come to the issue of delegate acts. So I don't know what is going to come there. On the other hand, we know from the President of the Commission now that she is planning to reintroduce the concept of the emissions trading scheme. And therefore, the two are tied together. Either you get financing from because you're sustainable, or you're running over to go and start capping your CO2 emissions and start trading cap and trade. I'm not sure which way we will go, but we must be very vigilant in the shipping industry because that regulation, it does evolve with externalities. It has nothing to do, as far as I'm concerned, about shipping. It has to do about sustainability of financing from the financial institutions and the packages they offer to the public. As an engineer, though, I have to say that regulation, it's not the problem. Standardization is the beginning of the problem. If we standardize things, maybe the industry can solve issues by itself by having the legislators imposing legislation.
Yes, Stavros.
I would like to reply to my good friend Christos. Shipping has been acting responsibly. Maybe not on all fronts. Maybe the recycling, which is something that the industry needs, the scrapping element. Maybe we are not there yet. The green recycling has not been fully implemented, and not all companies abide by these principles. But on the other hand, the shipping companies do invest on the ships. They do invest in making the existing vessels, and I'm mostly referring to the mid-age tonnage, which will be around for the next 10, 15 years, in making them more efficiently. Especially as a public company, we are familiar with the solid corporate governance practices, and we have been actually investing a lot of money on implementing new technologies on our ships, which have allowed us to improve very much on the consumption of the fleet, and together with other stakeholders, for example, together with Cargill, who are also very active.
As charterers.
Yeah. On the environmental front, they have invested in one of our ships to install energy-saving devices, to install propulsion efficiency devices, basically improving the efficiency of the vessel by 5 to 7%. On all our ships, we have monitoring systems which allow for real-time monitoring. This, together with our propulsion and hull cleaning policies, has allowed to reduce the consumption of the fleet and by 2 to 3%, and also the greenhouse gas emissions of the fleet. So we're doing things. But the question is the ship owner the only party who's responsible to pay for the changing regulation and for the environmental regulations that come into effect? And by paying, as we heard in the previous panel, this industry has not been profitable for the last 10 years, or the returns to shareholders have been marginal. We have other stakeholders, like the charterers, the banks, I'm not calling the banks to pay to make our vessels more efficient, but I mean at least the financing terms that are provided to upgrade the vessels should be much more favorable. And I'm going back to what you said before about the bank shareholders calling the banks to spend their money on specific industries who have a low GHG footprint. I mean, I came across the Banking for Climate Change report for 2019 the other day. I saw that the 33 global banks have spent 1.9 trillion in the last 3 years, so the 3 years after the Paris Agreement, to finance the fossil fuel industries. This equates to 70% of the capex of the industry.
Sorry, just speak closer to the mic.
This equates to 70% of the capex of the fossil fuel industries. So in the same era, when shipping is struggling to get 40 or 50% advances to finance new buildings of green technologies, the fossil fuel industry is enjoying the support of the banks to a very large extent. So I think that an equitable approach should be followed by the banks and not penalizing shipping, because we see shipping is something tangible. I mean, we see the vessel, okay, we see its exhaust, we say it's a polluting industry. But it's a polluting industry, I mean, it's covering 90% of global trade, and it's contributing only 2.5% of the global greenhouse gas emissions. This is not a very bad record.
Can I say something also to... Also, partly in response to my new friend, Christos, who I met today. So on ESG, sound ESG practices, we also see that as our responsibility to shareholders, to our clients, communities, and the environment we operate in. And sound ESG practices is what's expected from borrowers. It's become part of regular due diligence, and we think it'll be part of just a normal KYC going forward. So we want to lend to ship owners who understand that and are truly committed to that and committed to doing the right thing. In shipping finance generally, we think in the short to medium term, further capital is going to be leaving the market, and regulations which will continue to come into effect will drive up the capital requirement and also pricing. Many of those, and in fact most of those regulatory requirements, Macquarie applies already. And we think, and many in this room know Macquarie and the type of finance we provide. And the way we run this business, and by the way, purely on a bilateral basis, on a standalone basis, not with a strategy to cross-sell, we think it's a very sustainable business for us.
Thank you for having this conversation, because please allow me to say we have a unique panel of bankers in front of us. We have Macquarie Bank, who in the frenzy of the banks leaving shipping is one of the newest banks that is there available, has availability of funds, and it has gotten into the shipping industry. DNB, of course, who has always been the traditional banker in shipping, but has changed strategies over time, and Citibank, who is the cornerstone of shipping and shipping finance. And I'd like to give Chris to say something, and then you can rebuttal.
Yeah, just
I need to hear from your long-term experience.
Yeah, just a couple of points. Look, there are things we can do in the banking sector and things we can't do. We can't be the policeman to ensure compliance on the part of all of our customers. We just can't do that. It's not our job. Our job is to provide finance to allow our customers to expand, prosper and grow and hopefully be profitable. What we can do is to refuse direct finance to those industries that contribute the worst to the pollution. And for a long time, Citi has signed up for the Equator Principles, and we have added to those principles along the way. Now, we have been just the same as every other financial institution, been plagued with the regulation that has been brought about, whether it's KYC, AML, and it's been brought about because of catastrophic failures within our industry to manage properly. So the interesting thing about the regulation is that it tends never to be proactive. It's always retroactive. It's always to fix a problem that we have either not observed or we've ignored. So, you know, we have to deal with that problem ourselves. And I can probably speak for my other banking colleagues that these compliance departments are now the largest departments in our organizations. They're absolutely huge and they've taken over our lives completely. But we have to live with that. The other aspect to this regulation is, and being responsible, which is partly what this panel is about, is that we have to be able to measure what we have put on the books. And the Poseidon Principles is really a first step in that direction of being able to measure today how the loans that are secured by ships, what pollution factor do they contribute. And the Poseidon Principles is really only about gathering data that ship owners today already are obliged to provide to the IMO and collecting that data and measuring our performance. Are we improving? And that's kind of how we have to be accountable. I can see other nuances that may develop. I see some good things that are coming out of this uncertainty that everybody in the community now faces about future regulation. And that uncertainty has led to a major slowdown of orders because people don't want built-in obsolescence. They don't want to build a ship that they take delivery of in 2-3 years and then find that the rules and regulations have changed and they then got to go out and either spend a lot more money or they've got to write down the value of the ship because it no longer complies. So that's a very good thing. Just to make a comment before that was made before about responsible finance. Banks actually have done some pretty irresponsible things in the past by allowing to finance of 100+ ship orders in narrow segments. And you know, the biggest downturns have always been created by over-ordering. And it's been these, you know, very major orders that have started the slippery downward slope. And actually, if I go back, this has been the historical norm. I mean, my experience in this industry only goes back to the mid-70s. But even then, you saw the big orders being put through by C.Y. Tung and Y.K. Powell, 120 ships, 117 ships. And then you look at what was done with the dry bulk and product tankers by Scorpio. You know, history has a great way of repeating itself.
True.
And that's aided and abetted by the banks who provide the funds to allow it to happen. So I think if we look at where we are today, the good news is that we don't see huge orders like that likely to come about because of the uncertainty and what regulations are going to require from ships.
Okay, so you put another aspect. That regulation is helping us contain ourselves in overordering or changing the landscape because we're being restrained right now because we need to see where the future takes us. But once that equals off, here we go again. This is shipping.
Yeah. I mean, we've been asked to quote for tonnage, but with the one proviso that the owner doesn't take the risk of built-in obsolescence. And that's a conundrum that, you know, means we probably won't be able to bid on a particular.
So we're adapting and evolving. Excellent.
I need to get back to ESG just for a second because it was very interesting to see the reaction. Guys, ESG is not going away. It's at the top of the agenda the last couple of years, and if anything, is going to become even greater. It's very easy in closed forums like this, where everybody is involved in the shipping industry, to say that we are great, we are doing everything, and it's fantastic, and you know, it's amazing. The reality is that if you take capital into shipping and if you take banking money into shipping, it has halved the last 10 years. Banks are exiting the one after the other. There are other sources of capital that are coming in. We spoke about green financing.
Which are not regulated.
Which are not regulated. It is extremely important, and Stavros, you said you're taking a lot of initiatives when it comes to emissions, a lot of initiatives when it comes to scrapping. That is absolutely what shipping companies should be doing. It should not be viewed as a necessary evil, because this is what society demands us to do. This is what your children will be asking you. How are you scrapping your ships? When they see pictures of little children in India, utilizing every single piece of scrap metal, they're going to ask you, why are you involved in this industry? So we have to really, and this is becoming very high in the agenda, and unless we really take a very proactive step, we will stay here congratulating ourselves about being the best and being responsible while the market is moving away from us.
Exactly.
That's my point.
Change is here. I said that we need to adapt and evolve.
I think I completely agree, and I also think for large parts of the unregulated financial providers, many of the funds, they raise all of their capital from pension funds, insurance companies, endowments, and they, when they commit to these funds, have similar requirements. So I think, ESG is definitely
will trickle down to the end person that is putting in the money. You have something to say, or I want to go back?
I do agree with Christos. I mean, we are all conscious of what's happening in the environment, and we all want to be on the right side of history. But I think that shipping needs to do its part. It's doing its part. It's starting. There's a cultural shift. We're going to get there. Banks should also be contributing. Charters should also be contributing. I'm going back to the discussion of Danai and John before. I mean, the charters who are actually the end users of the vessels should not always get a free ride. Regulation should be applied across the board and not only on ship owners. And as I said before, if I were to stay in the shipping industry and I wouldn't in the banking industry and I hadn't moved on the ship owner side, I'm pretty sure that my children looking at images in the TV of oil exploration in the Arctics, they would again ask me, why are you financing these things? So it works for everybody in the same manner.
Okay. Can I just change a little bit? Because we can beat this over and over again, but I need to take it one step further. Andreas, we're talking about big data that is now being collected. Do you believe, from your experience, that technology will assist in all of this, or will just complicate our life even more? Or do you have another viewpoint?
No,
because you talked about standardization and technology is all
I do strongly believe that technology can solve the problem. We started with the reckless driver and the reckless car, if you remember. So there is no smart, reckless car. The more the ships are becoming smarter.
Oh, we have a BMW in 2022 that's going to be automated computer.
Yeah, that's computers on wheels.
If it can make coffee while it's taking me down to work, I will buy one.
What I'm trying to say is that I believe, if you look on the Poseidon principles, two things are there: transparency, accountability. If you have a trace of events, you have transparency and accountability. And that's what we're all striving now. We're collecting data. We see what's going wrong, what might cause a failure. And if that failure is caused, what's the risk afterwards or whatever. And in the big data, you can analyze it and see, you're going to do deep learning and find out to do predictive models whether this asset is a risk or not, the way it's been run or the way it was run before. Now, technology will provide everybody with information. We'll provide them with data to analyze, and whether it's a financial institution, whether it's the owner, whether it's the charter or whatever, they can come together and find a solution. But we have to see that this is part of the whole transport logistic chain, and it's not just for the ship. And we see from the environment I'm coming on now, I'm trying to optimize the port code, which involves the ship connection to the port and the logistic chain. And if we see certain sectors, they're getting more pressure by the actually platforms. I'm not naming them because you know who they are. The e-platforms that they're selling finished products, they want to know exactly where every single box is at every single moment. So the transparency is coming because of this pressure.
I understand insurance is really using
Insurances are interested to see there is I
which
know
goes
that
back to financing because they also need to be.
I'm aware of a club that is experimenting of collecting IoT data and say I'm gonna use this for your premium. So we're there, and okay, the question comes, the ship that became smart will be the same as the ship that is being built smart. That's the egg and the chicken question that we're going to have in the next 15 years. But answering your question and not being my conclusion, yes, technology can help. And I think technology can bridge the gap that we are in right now, whether I'm right or you are wrong.
Yeah.
Technology will provide the means to close this gap.
But I would like to ask my bankers, if all of that happens and we have a very compliant owner and a very compliant ship and a very compliant group, would that affect your terms, your covenants, your pricing? I mean, all of that at the end of the day comes down to dollars and cents, okay? And we are now saying that ESG will affect the ratings, will affect the cost, it's going to be costing the owners. Will that positively be reflected when I am a very good owner with a built or refurbished but very environmentally friendly, and I tick all the boxes of ESG under environment, social, and governance?
You have to tick the boxes.
Yeah.
That's the thing.
Okay, and let's just say I tick them.
If you're not ticking the boxes, you will not get capital, full stop. If you're ticking the boxes, you will get capital at rates which are profitable for the institutions that are providing them. And this could be banks, could be bondholders, could be whatever.
Okay.
The problem is that if you're not ticking the boxes, the capital is not there at all going forward.
All right, so.
From Western institutions.
And pricing is driven by capital, as I said, and regulations. So if these changes impact regulations and a reduction of capital, that will drive, of course, price.
Of course. Yes, Chris.
I would absolutely agree that we should be rewarding the behaviour that we want to see. And, but I also...
While we still have a two-tier playing field.
Yeah, but I also agree with my banking colleagues that the rates at which we make capital available are driven by factors other than these laudable compliance with ESG principles. Within Citi, I can tell you that, because our share price languished, the senior-most managements had their goals changed, and that changed how they asked us to make capital available, so that, overnight we had a complete change in how we were allowed to charge for the capital that we make available. That has nothing to do with ESG. That has to do with how the board and the
policies and shareholders and stakeholders.
How they are being taken care of. So it may not be fair, but it's reality.
It's reality.
And I think that there may be a different way that we've got to get to this rewarding of the right behaviour. Not sure I know what the answer is yet.
I think nobody does. We're coming very close to our time, and we would like, people are about getting hungry for lunch. Can I have, in closing, one remark from each one of you, as we have now, I think, debated that things, in order to get better, may get worse, or definitely change, and definitely change. So I'll start from the same side. Korinna?
Okay, so the conclusion is that you have to improve day by day. You have to improve your corporate governance. You have to be transparent, to have open channels of communication, to improve the company, comply with everything, and being very close with the bankers so that you have a chance to get the funding.
Okay. Stavros?
I guess, yeah, the conclusion is that ESG is here to stay indeed. So let's work all together to tap on the significant untapped potential that we have to improve on the greenhouse gas emissions of the existing fleet. There are many operational and technical techniques to do so. And we ask for both the cooperation of the banks and for the charterers to work next to the ship owners and achieve the best result in a very short period of time.
My parting comment is we are going through a period of great change, and we are going through a period of great uncertainty when it comes to shipping. This is exactly the environment that shipping thrives in. So I'm very bullish about the times to come for our industry.
Thank you. Marc?
I'll end for me on a positive note. We're a very young organisation when it comes to shipping finance. We extended our first facility in 2017. Today we have more than half a dozen ship owners in Greece as our clients, and while capital is leaving the industry, we've become very, very active and plan to triple our portfolio in the next couple of years, and are very committed to the Greek market.
Great. Alexandra?
I'm also positive. Going back to our beginning and where we are today, I think the fact that our sector can adapt so quickly to the changes is something very positive. So from the 10-page loan to the 140-page loan, etc., I think that's a very positive change. And also the fact that we still have loans, and we're still documenting loans, and there are still transactions, new transactions from traditional bank lending.
Thank you for that. Yes, Chris?
Well, what I would say is, in conclusion, and this is a theme that I think has been echoed throughout this day, is we don't know what we don't know. And shipping is a community of survivors, and they've been fully accustomed to dealing with cyclicality, volatility, and the unknown. But that said, there are measures of self-help that are available to this community, and I'm sure that they'll use them. And I think, as Tom says, we have time, and I think we'll use that time to get ourselves shipshape.
Okay, good. Andreas?
We know that we cannot live without shipping, okay? I mean, half of the world will frozen and the other half of the world will starve. So that's the bright side of the whole story. And the more bright side from my side is that we're very clear, if we are all familiar with the expression environmental losses on the financial side or on the expression side, embrace the new technologies and the digital tools because they eliminate environmental losses. We are not anymore saying, I'm sustainable. I'm sustainable and I have proof. I'm sustainable because I've done this. Therefore, for me, the bright side of the whole story, if shipping, which in my opinion is already done it, they're embracing technology quite fast. Maybe they don't embrace it because regulation is not there sometimes, but that doesn't mean the whole of shipping is doing that. So it's embracing technology, and I believe technology will eliminate environmental losses, and that immediately will resolve the problems with the financial institutions because then they're sustainable. There's no box to tick anymore, there's proof.
And I guess the technology is also there for the smaller, medium-sized companies that will assist them to take them forward towards this direction.
In my opinion, digitalization is a tool, and it can be big and it can be small. No one size fits all, but if you do actually make your analysis correct, it doesn't mean to spend lots of money. Sorry for, this is not an advertisement, but my platform is free of charge, for example, and it doesn't need any software, and it doesn't need any hardware. It only needs a computer.
Yeah.
As long as you have a PC, even a 386, you can try and do protocol optimization. So, if that's so simple, I'm sure that, and I'm aware of 1 million of tools out there.
Available.
Because, let's be honest, some of them are still startups. We have to look what they're doing.
Well,
but
this is a new era in this digitalization. Yeah, it's a new era. Well, thank you very much. I'm honored, and thank you for accepting our call to join the panel. I hope you have enjoyed this. I know we haven't answered the debate. I think we left it out there that can it become, I'm a positive person, and I think it will, under certain circumstances. Change is here to stay, we need to adapt. Despina, Travlou, thank you for inviting us, and thank you.